Hello and welcome to this special edition of Money in Motion video blog. This is Dan Perkins and thanks for watching. I sent you an update just a few days ago, but given the volatility of the latter part of last week and the continued volatility through the end of the third quarter and the beginning of the fourth quarter, I decided that we needed to know another update. So let's see if we can figure out what's going on. A lot of things have happened in the last 30 days. Things that have not been around for a long time. For example, for West Texas Intermediate crude oil, delivered in Oklahoma, hit a low on Friday of 83.20 before it bounced back to about 85.50. That 83.20 is a level that hasn't been seen in a number of years. In addition, there's been a contraction of the spread between the cost of West Texas Intermediate crude, which is the best crude and the easiest to refine and produces more gallons of finished product than Brent North Sea crude or Saudi Arabian crude. And that crude is around $91 a barrel. What's been happening over the last 2 or 3 months is that the spread between the price of West Texas and Brent North Sea has been narrowing. In fact, at one point on the day on Friday, it was only $2 a barrel. Now, understand that many Middle Eastern countries who are refining crude oil need something north of $85 a barrel. Saudis is the cheapest, about 85. Iran, for example, needs 119 to break even. This means that there's going to be some significant pressure if this stays down low for an extended period of time. There goes that Fed phrase again, extended period of time. It's going to put a lot of pressure on the Middle Eastern oil or OPEC oil economies. We have a problem because we have been developing our resources to the point that we are now the #1 natural gas producer in the world, and we may very well right now be the best and the cheapest and largest oil producer in the world. What's interesting to me is that the Brent North Sea crude had normally carried about a $15 risk premium, meaning a political risk premium, over West Texas. And in what I said last week, I thought it was possible that West Texas could go to $71, $73 a barrel. I still don't think I'm even more convinced that that can happen based on what happened on Friday. But in addition to that, the whole commodity complex is near the low, or clearly the low for the year, if not the low for many years in the past. When you have a decrease in demand for all of the commodities, what the commodity markets are saying is that there's going to be less demand on a global basis. Now, one of the things that took place this past week, which I didn't report because I didn't know about it at the time, is that the World Bank announced that the U.S. economy is no longer, in terms of GDP, dollars and cents of GDP, no longer the largest economy in the world. The Chinese economy took over as the #1 spot from the U.S. in the end of 2013, early 2014. Just to give you some idea of the differences in the growth rates. Over the last 6 years, the average annual growth rate of the Chinese economy has been about 7.3. Over the last 6 years, the American economy has been averaging less than 1%. Which means that in a 9-month period, the Chinese economy grew greater than the United States economy grew in the previous 6 years in total. It's really an awkward feeling to think that we're no longer the biggest economy in the world. It seems hard to believe, but the numbers are the numbers. So I think that part of the reaction that we're seeing on Wall Street is the realization that the 6 years of the Obama administration that was full of hope and change in the beginning has not turned out to produce the hope or the change. With a decline to the second leading economy in the world, that's not an impressive legacy for the president to leave. And wonders how that's possible given supposedly all the job growth and all the positive things that are happening. We still have an effective unemployment rate in the United States in excess of 11%. We don't have an unemployment rate at 6% that you're reading in the papers, in excess of 11%. probably higher than that because there are millions and millions of people who've given up looking for. I think Wall Street, which was one of the beneficiaries of Obama's election and the stimulus and the whole program with the Federal Reserve buying trillions of dollars worth of government securities and bonds, provided enormous amount of cash for Wall Street to prosper. Now that the the Federal Reserve Chairman Janet Yellen has said that they're done with their buying, the economy can't stand on its own, and the street begins to wonder if the American markets are truly valued. But if we look at currencies, the dollar is at 12 months high against all major currencies. It wasn't that long ago that you got you had to pay 135 to 137 euros to the dollar. Now it's 123, 124. Wasn't that far ago that you paid 167 on the UK pound. Now it's around 160. Japanese yen was selling at a discount at 97, 98. Now it's at 108, and on and on. What's happened as the European Central Bank, in order to try and stimulate their economies by lowering interest rates and performing quantitative easing, have devalued their currencies against the United States dollar. That's both good and bad. It's good for the local currency because it makes their goods cheaper compared to the United States. Bad for us, meaning that our exports to around the world are going to be more expensive. Energy was a very important part of the decline in the market. So was technology. There's probably very few sectors, if any, that have unscathed in this decline. What we've seen is that for example, that the Dow Jones and the S&P 500 have dropped down to their 200-day moving average. From a technical standpoint, 200-day moving average is major support for the market. We broke through to the 200-day moving average of both the S&P and the Dow on Friday. And I think that we're not done going down. I don't know how much further we're going to go, whether we're going to go 5%, 7%, or 10%. These markets can build their own momentum. But I think it's important for you to understand, even though your portfolio in value may have declined, and I'm sure it has, as mine has too, it hasn't declined as much as everything else because we have the S&P 500 double short. So as the markets fall and we lose some of the value in our stocks, the short position that we have in the S&P 500, both the double and the triple, are adding some balance to offset those declines. It's that insurance policy that we talked about when we first set up your account. It's still there, it's still in play, and it's working. Does that mean it's going to work forever? You know, at some point in time, this market will turn. Probably when it gets to the point that it's going to turn, there'll be a reflux rally. Could be significant, could be 300, could be 400, maybe even 500 points. That's probably a false rally, and we'll have to come back and retest the bottom again. We're in for a great deal of volatility. There's a lot of uncertainty going on in the United States and around the world. Going back to the Chinese being the #1 economy in the world, if the markets continue to decline and the economies continue to contract, by the way, International Monetary Fund put out an estimate last week that they thought that the growth rate for the American economy will be about 1.2 to 1.5% for 2014. It's not a pretty picture, but I think the markets are somewhat oversold. They'll probably when we think we've hit a bottom, we'll get a pretty substantial reflex, rally. Then I would expect us to see us come back and probably test the low again to see if the low will hold. And if it holds, I would be a buyer, looking for additional yield. All of the accounts have cash for the very reason that no one can predict the outcome of the markets or the direction of the markets 100% of the time. And by having cash, seeing an opportunity creates an opportunity to buy. And we're going to pick up some things, I think, at some very attractive yields and prices. But probably you're thinking about, is this another repeat of 2008? I had a client kept telling me that he got an email from solicitation from another broker saying that the market was going to decline 60% in 2015. Could be right, I don't think so, but we're not going to experience a 60% decline. Why? Because we have so much income producing investments, they tend to dampen the volatility. So if the market's going to continue to decline, we're probably going to continue to decline some of that, but we're also going to be in a position to protect some of that downside with the S&P shorts that we have in place. It's not a great time. Everybody likes to see their portfolios go up. And it's a difficult time when they see the market seemingly falling apart and crashing with no real direction. I said to you many, many years ago, when I was involved in developing the first global fund to invest in sovereign debt, that meeting with the Swiss bankers who took care of the world piece, they told me, Americans make decisions based on emotion. We make our decisions as Swiss bankers on facts. I have found myself over the last 40 years dealing with those issues of emotion. I know it bothers you and it makes it very uncomfortable. I understand that. But I'm looking out after your money not from an emotional standpoint, but from an intellectual and a rationale standpoint. And if there's a rationale to own it, then if I get a chance to buy it cheaper, I should. If I shouldn't, I should get out of it. So it's still going to be some volatility, probably this early part of this week, maybe some stabilization towards the middle of the week, maybe a rally by the end of the week, and then we're going to see probably a test of that, whatever the low is. So I'll keep you informed, let you know what I'm thinking. Thanks for watching.